Very good evening, members. Hearty welcome to each one of you for today's study circle on a very important topic, MAT and AMT. We have with us CA Vishnumurthy sir to present on this topic. Very happy you are here, sir. Welcome on behalf of Bangalore branch, or inter-committee, and also on behalf of all the participants. Members, before we proceed, I would like to make a couple of announcements. We have a one-day workshop on valuation on 25th of April at Bangalore branch, Vasant Nagar premises. Request all of you to kindly register for it. Also, we have AQMM virtual CP meet on 27th of April. And we have one-day seminar on intangible property rights law, which is a physical program, on 29th of April at Vasant Nagar branch premises. So requested you, all of you, to kindly participate and take part in it. Now I request our managing committee member, Rachel, to kindly give a brief introduction about our speaker of today's program.
Good evening, members. I take this opportunity to introduce today's speaker, CA Vishnumurthy Sir, to this August gathering. CA Vishnumurthy Sir is a chartered accountant. He is also a law graduate. He has been in practice for over 3 decades. He has been handling taxation, both direct and indirect tax, audits, and to some extent advising on corporate restructuring. He also enjoys sharing ideas in the open forum and matters relating to professional ethics. With this brief introduction, I present to you CA Vishnumurthy Sir. Over to you, sir.
Thank you very much, and good evening to all the participants. At the outset, let me thank Divya Madam and other members of the Managing Committee of Bangalore branch of Southern Regional Institute of Chartered Accountants of India. I have been given a topic, minimum alternate tax and alternate, what is that? Yeah, minimum alternate tax MAT, and okay. Now coming to this minimum alternate tax MAT, to be short, is something to do with companies, as all of you are aware. Probably it is worthwhile to have a brief background. Probably familiarize ourselves with a brief background leading to the scheme which deals with this MAT. Now, to spur the economic growth, Finance Minister normally uses income tax provisions as a tool. They provide a lot of incentives under the Income Tax Act, which spurs economic growth. But unfortunately, what happens, the benefits of this economic growth takes some time to be realized. Therefore, the announcements or the incentives provided by one finance minister generally accrues to the benefit of the following finance minister. This creates some sort of heartburn for the person who has foregone the income tax by making available the incentives. Therefore, at some point of time, the finance minister thought, why not we collect tax initially and thereafter allow credit for such tax at a later point of time. This will ensure that tax will be collected uniformly by all the finance ministers and obviate the need for somebody to feel some sort of dejection or whatever you want to call it. So basically, I am looking at MAT as a cash flow management by the central government. In the initial years, even though tax is strictly not due, they collect the tax and retain it with themselves and allow that to be utilized in a later year, of course, subject to certain conditions, So in a way, it is a simple input tax credit mechanism which is being practiced heavily by the present day government. So initially when MAT is paid, you can say the person who is paying the MAT becomes eligible for certain input tax credit kind of a thing, which he is capable of using it in a later year when he has to pay a regular income tax. The other thing that is being cited as a reason for introducing MAT is that companies make huge profits, particularly big companies make big amounts of profits. But because of various incentive schemes given to these companies and with the help of good tax advisors, companies are able to reduce their tax outflow, which directly affects the government. Government's tax receipts come down, but the company's profits soar. And when the companies make huge profits, it is but natural to expect that they would declare dividend and reward the shareholders. So there used to be a scenario where companies used to declare huge dividends, but at the same time used to claim that we need not pay any tax, and not paying such tax is as per the provisions of the Income Tax Act. These companies came to be known by a very nice name called zero tax companies. Like you have today zero rate supplies, there used to be a time when there used to be zero tax companies. Companies would make huge profits, but they would not pay any tax or almost zero tax, and they used to be called as zero tax companies. To bring the zero tax companies into the tax net, they devised the scheme of minimum alternate tax. Now, what is this minimum alternate tax scheme, or what we call it as the MAT scheme? Basically, there are a couple of components in this MAT scheme or MAT charge, I would like to call it as. First, there is something like book profit. Book profit is nothing but profit as per the books of account of the company, with, of course, certain adjustments being made to such profits. So on one side, there is book profit. And as all of us are aware, there is something like total income. That is income earned by the company being computed under different heads of income by applying the rules applicable to these different heads, adding them up and arriving at what is called as the total income. Normal scheme is that you arrive at the total income, apply the applicable rate of tax, and arrive at the tax payable by such company. Under the MAT scheme, you determine the book profit, that is profit as shown in the profit and loss account or statement of profit, and after making certain adjustments, you can call it as adjusted profit, apply 15%. This is the MAT rate. 15% is the MAT rate. Compare these two figures, that is 15% of the adjusted book profit and the tax payable on the total income. If the tax payable on the total income is higher than 15% of the book profit, you totally forget about the MAT. You don't even think about MAT. On the other hand, if the tax on the total income is less than 15% of the book profit, then you come under what is called as the MAT net or MAT provisions. So MAT becomes payable when the tax on your total income is less than 15% of the book profit. Now, this book profit takes the position of total income, and therefore the section says such adjusted book profit shall be treated as the total income, and the tax payable on such total income shall be 15% of that such adjusted total income. This takes us to the next level. What actually is what are the adjustments that need to be carried out to the profit shown in any statement of profit and loss? Now, first of all, profit and loss, we are talking of profit and loss of a company or statement of profit and loss of a company. So there are statutory requirements which need to be complied with in the preparation of such statement of profit and loss. What are all the statutory requirements? Spelled out in section 129 of the Companies Act. Basically, what it says is you should have accounting policies which are in sync with the GAAP, and there are prescribed accounting standards. One can refer section 133 in this regard. So by applying the accounting policies and the accounting standards, one should prepare the statement of profit and loss, and the profit shown in such statement of profit and loss is the beginning point for determining the book profit. Now, there are certain issues that may arise. No doubt, Companies Act requires every company to prepare a statement of profit and loss. At the same time, it also gives certain leeway to certain companies. For example, if the company is incorporated, let us say after January 1st of a given year, ideally one would have expected that such company would close its books of account on 31st March. But the Companies Act provides an exception in such a case, saying that if the company so chooses, they need not close the books of account in the immediately following March. They can close their books of account for the first time in the March of the following year. That means the financial year can be of a 15-month duration. Or the profit will relate to a duration of about 15 months. This is just not suitable for our income tax purposes, because income tax always believes in assessing the income of the previous year, which necessarily means a period or year ending on 31st March. Therefore, even if the company is incorporated after 1st January, the financial year for the company would end on 31st March. So profit or income earned between the period commencing on the date of incorporation and ending on 31st March will have to be reckoned, and this becomes the income on which the company becomes liable to pay the tax. Now, for the purpose of MAT, we have already said that we should identify the book profit of the company. Company is not preparing its statement of loss, statement of profit and loss. So how do you ensure that the company has a statement of profit and loss? Therefore, if you see section 115 JB, they are not relying on the statement of profit and loss prepared for the purpose of the Companies Act. They in fact mandate that every company shall prepare a statement of profit and loss for every previous year, that is year or period ending on 31st March. Now, that profit and loss has to follow the same accounting policies and the accounting standards, and probably the method of depreciation and the rate of depreciation as the company would have followed if that statement of profit and loss were to be placed before the shareholders. That is the requirement under the Companies Act. But under the Income Tax Act, with this small change, that company has to prepare the financial statement as of 31st March of every year. The rules, whatever is applicable under the Companies Act, will also apply here. Let us take one more case. For example, foreign companies. A company which is incorporated in US, it has got a wholly owned subsidiary in India. And the holding company in US is required to consolidate the financial statement of its subsidiary in India. In US, companies prepare their financial statement based on calendar year. That is, they close the accounts on 31st December. So to be in sync with the holding company's policies, Indian company is also required to close its books of account on 31st December. Government, in its wisdom, has introduced a provision under the Companies Act saying that such companies, after taking permission from the central government, can have a financial year which is different from the normal financial year, that is April to March. So even in the case of foreign or rather Indian subsidiaries of such foreign companies, there can be a problem as far as income tax is concerned. You may not get a financial statement which is ending on 31st March. You may get one which is ending on 31st December of the previous year. Therefore, this particular section mandates even such companies that they should prepare a financial statement which is ending on 31st March of every year. So uniformity has been sought to be achieved by this particular provision. Of course, wherever companies prepare their financial statement which is ending on 31st March of every year, problem is very simple. Same thing need not be duplicated. This, whatever is prepared for the purpose of Companies Act can be adopted for the purpose of Income Tax Act. And the profit shown in such profit and loss account can be treated as the book profit for the purpose of MAT. Now, the other issue that may arise is when you are adopting the financial statement prepared under the Companies Act, which has been audited by chartered accountant, there can be a couple of issues that may arise. For example, accounts might, or the financial statement might not have been prepared following the accounting standards. Auditor might have qualified it. So there is a profit figure in such financial statement. Can you take the profit shown in such financial statement without any adjustment is the question. Or if at all a financial statement is a qualified one by the auditor, whether suitable adjustments based on such qualification will have to be carried out. Now, under the Income Tax Act, I told you in the beginning, there is a mandate that the company should prepare its financial statement following the accounting standard. Now, here is a financial statement which is prepared by deviating from the accounting standards. So naturally, if you are going to adopt the financial statement prepared for the purpose of Companies Act, it definitely requires adjustments which will take care of the qualification given by the auditor. Or it should be a financial statement for which the company would have got a clean report or an unqualified report. So you cannot take the profit shown in a qualified financial statement as the book profit. You will have to necessarily carry out the adjustments and only after that, the adjusted profit should be the beginning or the commencing point for making the book profit for the purpose of our MAT. Now, what are all the adjustments that are required to be made or which have been prescribed under the Income Tax Act? Let us come one. First and foremost, there are certain broad principles which need to be borne in mind. In the beginning, I made a reference to companies declaring huge dividends out of their profits, and yet for the purpose of income tax, showing either a loss or a very low profit. So MAT is introduced only to take care of this. Therefore, MAT provisions probably will ensure that profit that is available for distribution as a dividend should be the basis for levying tax under the MAT provision. When it comes to distribution of a dividend, one can refer section 123, if I'm right, which talks of profits which are available for distribution as dividend shall not include notional profits or unrealized profits, or which are notional profit, unrealized profit, or profits which which do not ultimately result in collection of any resources which can be distributed as dividend. So when you are making the adjustment, the point to be noted is all such items which are found in the statement of profit and loss, which are mere book entries and which do not reflect any transactions, have been kept out. That is one part. Second, there are items under the Income Tax Act, items of income, I would say, which are taxed at a rate less than the MAT rate, that is 15%. They do not want to tax them at MAT rate when the statute itself has provided that they shall be taxed at a rate lower than the MAT. For example, income by way of interest or dividend, etc., earned by foreign companies on their investments. These are taxed, I think it is about 10%. Now, these have been kept out from the books, from the book profit, so that they do not get taxed at 15% by treating them as part of the book profit. Now, I made a mention about these foreign companies. Probably let me touch upon a little bit more on these foreign companies. Now, foreign companies, when I say foreign companies, companies which are incorporated abroad and which have operations in India. These operations might be carried out through a permanent establishment established in India, or it might be carried out without having any such permanent establishment. Now, MAT is payable based on the book profit. First of all, take the example of Google. Let us say Google has a permanent establishment in India. You want to tax the book profit. Do you take the book profit of Google as a whole and try to tax it? It may sound quite stupid. But then we need to have provisions based on which officer should be in a position to keep it out of the tax net. So how is this done? So they have included an explanation whereby foreign companies have been classified into two categories: those having establishment in India and those not having establishments in India or permanent establishments in India. Foreign companies not having permanent establishments in India are totally outside the purview of MAT. MAT provisions are not applicable in their case. Now, foreign companies having permanent establishments in India are covered for the purpose of MAT. But then there are certain provisions which ensures that only the profits attributable to the permanent establishment in India are subject to MAT. How this is achieved? Now, companies having permanent establishments in India are required under the Companies Act to register themselves with the Registrar of Companies in New Delhi. It is a requirement under the Companies Act. They are also required to prepare financial statement pertaining to their Indian operations and file it with the Registrar of Companies. So basically, foreign companies which are having permanent establishments in India have to first register and also on an annual basis file financial statements pertaining to their Indian operations with these authorities. Now, this financial statement can be book profit. In section 115 JB itself, there is a clue which says that companies will have to prepare their financial statements in accordance with Schedule 3 of the Companies Act. Now, foreign companies are required to prepare their financial statements in accordance with Schedule 3 only in respect of their operations in India, not with regard to their operations in rest of the world. Therefore, foreign companies having permanent establishments in India will be asked to pay tax only on the book profit, which is relatable to their operations in India. Now, we have the book profit, which is the net profit as per the financial statement. And if it is based on an audited financial statement, after having made adjustment to take care of the qualifications given by the auditor. Now, what are all the adjustments that are required to be made? First and foremost adjustment is whatever amount that has been debited to this financial statement for the purpose of tax, current tax. Now, this income or income tax, let us put it as income tax. A question may arise whether the interest payable on income tax will also be income tax. This section itself provides the answer. It says the interest payable on income tax is also income tax. Therefore, any interest paid for whatever delay, whether it is payment of advance tax or self-assessment tax or whatever it is, that is also income tax. That gets added to the book profit. When an item gets added to the book profit, it also suffers MAT of 15%. Therefore, income tax which is debited to statement of profit and loss account will get taxed at the rate of 15%. What about penalties paid under the Income Tax Act? There are so many provisions dealing with penalty, 270A penalty, that penalty. So many such items are there. Whether this is also required to be added back to the book profit to increase the book profit and pay a higher MAT? The answer is no. If there is any penalty payment under the Income Tax Act for the purposes of MAT or for the purpose of computing the book profit for the purpose of MAT, it is an allowable expenditure. Cess, surcharge, etc. are treated as income tax. Therefore, if any such items are debited to the profit and loss account, they get added. Whereas penalty does not get added, it goes to reduce the book profit. If there are any reserves that is created by debiting the profit and loss account. Now, reserves, you know, it is a profit which has been set aside. So for all practical purposes, it is a profit and ideally it should get added to the book profit. Therefore, a reserve created for whatever purpose has to get added to the book profit, because when you are computing the net profit, that net profit would have excluded this reserve which has been debited to profit and loss account and transferred. As chartered accounts, we know many provisions are made. Basically, provisions are made where amounts are not quantifiable, or you can make only an estimate of the obligation. We also make provisions to meet certain contingencies. That contingencies means a liability which may or may not arise. Basically, if a provision is made for certain contingent liabilities or what we call it as unascertained liabilities. For example, a company is facing litigation. Directors feel that company may or may not win this case. And if it loses the case, there can be a huge outflow of resources or payment will have to be made. Therefore, they considered it as prudent while preparing the annual financial statement that a provision be made. Now, this provision is clearly for an unascertained liability because the obligation to pay has not yet crystallized. Forget about quantifying it. So if there are any such provisions that has been made, how the provision is made? Provisions are made by debiting the profit and loss account and crediting the provision. Such debiting will have to be reversed, or provision made will have to be added to the book profit. So provision made for liabilities will go to increase the book profit. And hence, a holding company, as a matter of prudence, even though it is not obligatory, generally provides for the losses its subsidiaries incur. Like I said, it is not obligatory, but as a matter of abundant precaution, directors may take a call and which might get approved by the shareholders to keep aside some portion of the profit to take care of the losses of the subsidiaries. So if any such entries have been passed or earmarking of resources has taken place, such debiting of profit and loss account will have to get reversed. So therefore, provision made for losses of subsidiaries will get added back to the book profit, and book profit will get added. Similarly, if there is any provision made for dividend, because dividend at the end of the day is a distribution of profit. It is not an expense that is incurred. It is an application of the profit that is made by the company. Obviously, it should be tax suffered first. So, for example, interim dividends are paid during the year. Obviously, they get debited. There is no question of it. Next, amount relatable or, sorry, let me talk about this. An agricultural company or a company producing agricultural produce, for example, company having coffee estate, which is purely agricultural. Agricultural income is exempt. Now, will we ask such company to pay MAT? Because the tax paid by such company under normal provisions is zero because it is agricultural income. Now, they have a book profit. 15% of the book profit is what I am expected to compute under 115 JB. Now, 15% of book profit is higher than the tax payable by such companies, whether such companies are required to pay MAT. The answer is no, and this is taken care of by saying that companies whose profit and loss account includes income which are not includable in total income under Section 10. As you are aware, Section 10 of the income tax deals with the income which are not includable in total income or exempt income, so we put it shortly in a short form. Exempt incomes are not includable income, and many such incomes are listed in Section 10. Agricultural income is one such income. Now, when my book profit is mandated to exclude incomes mentioned in Section 10 or exempted income, naturally, expenditure relatable to such income will also have to be kept outside the scope of book profit. Otherwise, these expenses will go to reduce my book profit unreasonably, or there is no logic in reducing such book profit by these expenditures since the corresponding income is exempt. So the section provides for adding back the expenditure which are relatable to income which is covered by Section 10. Agricultural income is an example that I am talking of. Similarly, there are companies which are engaged in charitable activities, which are commonly called as earlier Section 25 companies. Now, under the 2013 Act, these are called as Section 8 companies. These companies are also required to prepare their statement of profit and loss, and they are required to prepare it in accordance with Schedule 3 to the Companies Act. And they will also probably show a net profit or income over expenditure, whatever nomenclature you want to give it to such line item. Now, such incomes are not taxable under normal provisions. So, to say that I will include them under book profit and subject them to MAT would be going against the very scheme of the Income Tax Act. So, this provision 115 JB, which talks of adjustment to the reported book profit, provides for excluding profits or whatever you want to call it as income, which is taxable under Section 11 or 12. It also provides for excluding the expenditure relatable to such profits. So basically, expenditure incurred for charitable purposes and income received for applying it for charitable purposes get excluded from the book profit. Basically, non-payment of MAT. Then foreign income, like I told you in the beginning, there will be capital gains which are taxed at a rate lower than the MAT rate 15%. So naturally, when the income is not taxed under MAT, expenditure relatable to such income should also be kept outside the scope of book profit. So this particular provision provides for keeping the expenditure relatable to capital arising to foreign companies. Similarly, expenditure related interest etc. of foreign companies are also kept out. So basically, how do you keep it out? When they are expenditure, they were reducing the book profit. So now these items of expenditure. I have one small query to the participants. I want you to think about this. There is one particular section which talks, which is contained in section 115 BBF. Basically, this provision deals with the taxation of royalty income arising from patents developed in India as an incentive to people to do more inventions and register patents. The income by way of royalty on such patents are taxed at a lower rate, which is at 10%. And the corresponding section is 115 BBF. Because it is taxed at a rate lower than the MAT rate, it is kept outside the scope of MAT. Now, keeping it outside the scope of MAT is fine. The issue that arises is a company which is liable to pay MAT will have to treat its book profit as its total income. This particular royalty from patents developed in India is being kept outside the scope of total income by virtue of this provision. Once it is outside the scope of total income, there is no separate provision by which it can be taxed. So a question may arise, if a company is paying MAT, whether in the hands of such company, royalty income arising out of patents developed in India will also be exempt. Of course, there is one provision under 115 JB which loosely talks on other of this act shall apply to companies to the extent they are not dealt. One way is to understand that 115 BBF is not dealt with under 115. Therefore, other provisions, that is 115 BBF, which provides for levy of tax on such income, is applicable, and therefore tax can be levied. But I think there is here a elaborate on this. Now, there is depreciation. When it comes to depreciation can relate to cost of the asset, and wherever assets have been revalued, depreciation can also relate to such revalued amount. For example, if I have purchased an asset, let us say machinery, by paying 1 crore, I provide depreciation on 1 crore by taking that as the cost, and either by following the straight line method or written down value method. That machine probably is a scarce one. Today's replacement value is quite high. So I take a decision to revalue that machinery, and I revalue it at 1.5 crores. Once I revalue it, I will increase the carrying amount of the asset and create a revaluation reserve in my balance sheet. Thereafter, year on year, I try to depreciate the asset at such a revalued amount, which is now I am taking it as 1.5 crores. Every year, I will transfer from the revaluation reserve the amount of depreciation that I have provided on only the revalued amount. The original cost gets depreciated in the normal course. Let us say in between, I decide to dispose of that machinery. Now, the carrying amount of that machinery has come down to 1 crore 30 lakhs. Its cost was 1 crore. I am able to find a buyer who pays me 1 crore 30 lakhs. Now, the book value based on cost is only 90 lakhs. Revalued amount after depreciation or the carrying amount after taking into account the revaluation is 1 crore 30 lakhs. I am selling it for 1 crore 30 lakhs. My revaluation reserve is there at some amount, maybe about 30 lakhs or 25 lakhs, because it has not been transferred to that extent to the profit and loss account. Now, on disposal, first I will try to find out what is the profit that I have made. To the extent of my cost, I will compare the price realization and the profit is divided between two components. One is with reference to the original cost and other one is with reference to the revaluation cost, revaluation amount. To the extent of profit attributable to the original cost, it gets credited to the profit and loss account. And to the extent of the revalued amount that is realized, I have a choice of either crediting my profit and loss account or crediting that crediting directly the general reserve by transferring the revaluation reserve to the general reserve. So what happens is, to the extent profit and loss account does not get credited, or my book profit will not involve, book profit will not comprise or contain the realized revaluation reserve, because that would have got transferred directly to the general reserve. This is an accepted accounting standard under AS 10. Those who are interested can go through that. In such a situation, book profit does not contain this realized revaluation reserve, even though it is a realized profit. To take care of that, amount realized which is not credited to profit and loss account. So, moment your book profit gets increased, you end up paying MAT on the Then there is a little complicated provision when it comes to this business trust, or what you call it as a REIT. A developer may own an asset through a company. He may own the asset Am I audible now?
Yes, sir.
Okay. A developer who wants to go for a REIT arrangement may either transfer his asset in the form of real estate directly to the trust and get units of the trust allotted to him. And at times it so happens that he owns the asset through a special purpose vehicle, or what we call it as SPV, in which he will have the shares. So he will transfer the shares of the SPV to the REIT, and the REIT will allot him the units. This arrangement is not considered as a transfer for the purpose of capital gains. As you can see, in reality, he is transferring an asset, be it a building or shares in a SPV. He is transferring that asset to the REIT, and in exchange, he is getting the units of the REIT allotted to him. Ideally, it should have given rise to capital gains and it should have been taxed. But to encourage this kind of transactions and make everybody participate in this real estate boom, exemption has been given by treating this transaction as not a transaction involving transfer of capital asset. Now, for income tax purposes, it is not a transfer. But for the purpose of book profit or company's accounts, this is certainly a transfer and it gets recorded. It's a different matter. Capital gains tax is not paid, but profit on sale of the asset or transfer of assets will get recorded. Now, government has chosen not to tax this kind of transactions unless these are provided exemption under MAT. The very purpose of giving them exemption from capital gains tax will get defeated. Therefore, what the law provides is it continues to provide them exemption even under MAT by excluding them from the scope of book profit. Tax becomes payable on the sale of units, not when units are acquired by either transferring the building or the real estate asset or the shares of the SPV to the REIT. Now, coming to depreciation, I think we got deviated a little bit. Depreciation is initially added back because it contains depreciation both on initial cost of acquisition and also revaluation that would have taken place. If there is no revaluation, then there is no issue. If there is a revaluation, it gets added, and thereafter depreciation to the extent it pertains only to the initial cost of acquisition alone gets deducted from the book profit. So basically, book profit need to be determined by deducting depreciation based on your cost of acquisition and not based on revaluation. Now, we have seen the items which go to increase the book profit. Naturally, there will be several items which would have got credited to the profit and loss account and increase the book profit. And for the purpose of MAT, for various reasons, they need to be deducted or reduced from the book profit. Let us go through such items which will have to be reduced from the book profit. For example, there might be reserves on which you would have initially paid the MAT. Now, the company has drawn from that reserve and credited the profit and loss. For whatever reason, there might be so many different reasons because of which this because of which it would have withdrawn from the credited the profit and loss account. Such withdrawal increases the book profit of the company. If you do not make any adjustment, it would amount to paying tax twice. Initially, while creating the reserve, you have paid the MAT. Now, once again, when such reserve gets credited to the profit and loss account, you are going to pay MAT again. This is not fair. So therefore, there is a provision which provides for reducing from the book profit reserves which has been credited to the profit and loss account out of the reserves which have initially. Then there is a provision, like I said, items of income which are exempt from tax or items which are listed in section 10, like agricultural income, etc. These automatically get, even though they are not taxable under Income Tax Act, for the purpose of companies' accounts, they get credited to the profit and loss account. We have earlier said expenditure relatable to such items of income will get added back to the book profit. Now, here is a case where incomes which have been credited to the profit and loss account get reduced from the book profit. Then will be deducted only on the original, not initially when added, we added the original cost. Now we are reducing only the depreciation and original cost. This ensures that depreciation on revaluation amount gets back. Now, for foreign companies, we have seen expenditure relatable to items of income which are taxed at a rate lower than the MAT are added back to the book profit. So here is a case where such items of income stand excluded from the book profit. So in all, both income and the expenditure attributable to such income get excluded from the scope of book profit. Once they get excluded from the scope of book profit, they also get excluded from the scope of MAT. Now, there is another interesting item. This depreciation, accumulated depreciation, that is depreciation of past years which has not been set off for lack of profit or loss. Now, the least of these two, that is brought for accumulated depreciation or brought forward losses, whichever is less is allowed to be reduced from the book profit. Every company, in order to enjoy this benefit, will have to maintain a separate account of the brought forward losses and unabsorbed depreciation. And finally, see which is the least of the two and reduce it from the book profit. If any of these items is nil, for example, there is no accumulated depreciation or unabsorbed depreciation, then no deduction is available under this particular clause. Now, when I talk in terms of accumulated depreciation, it is whatever has happened in the past. Now, let us say for a particular year, there was shortage of profit, therefore depreciation could not be absorbed fully. In the next year, there is profit. Against that profit, this depreciation can also be set off. No problem on that. But the problem arises in a particular year, you have both unabsorbed depreciation as well as loss. And in the subsequent year, there is profit. Which one you will set off first? Will you set off the brought forward loss or the accumulated depreciation? There is no clarity. There are cases where companies' board of directors are dismissed by the central government and fresh board. And these are basically cases where companies either will have to be revived or there is total mismanagement. In such a case, in order to reduce the tax burden, the particular section 115 JB provides for deduction of both brought forward losses as well as accumulated depreciation. Whereas in a normal circumstances, least of the two is deductible. Whereas in the case of companies of this special type, total of these two items are allowed to be deducted, which means a substantial income tax on to such companies to help them. What about this deferred tax? Deferred tax asset as well as deferred tax liability. These are depending upon whether it is a deferred tax asset, whether it is debited or credited, either they are added back or they are reduced. For example, if deferred tax asset is created by crediting the profit and loss account or current tax, then to that extent, book profit is reduced. Similarly, if deferred tax liability is created by debiting the profit and loss account, to that extent, book profit is reduced. Now, there are certain items which are very peculiar to Ind AS method of preparing the financial statement. As you are aware, the statement under Ind AS contains a very item called other comprehensive income, basically, which deals with revaluation and reappraisal of gratuity liability, etc., etc. Now, as far as revaluation is concerned, the position is very clear. Revaluation profit, because under Ind AS, you have the choice of recording assets either at cost or on revalued value basis. Now, while doing the revaluation, adjustments are being made. These adjustments are not to be taken into account for the purposes of 115 JB. Therefore, we do not have much problem about Ind AS adjustments here. Now, after doing all this adjustment, we arrive at a figure which is called as the adjusted book profit. Calculate 15% of such adjusted as the tax payable, and that becomes the tax. Now, I told you, MAT is more or less a management of cash flow problem. So therefore, they will give you credit. What is the amount of credit that is being given to you? Now, you would have paid, but for this 115 JB or MAT provision, the tax under normal provisions, which could have been, let us say, it is X. because of this MAT provision, you are paying a higher tax. Let us say it is Y. This higher tax is calculated at 15% of the book profit, and the normal tax, depending upon the rate of tax, and also depending upon the total income, you calculate that amount. The difference between these two is allowed as tax credit or MAT credit. Now, basically what happens is you would have paid tax on your total income under normal circumstances. That is never given back to you. So there is no credit for that tax. Over and above that, because of this MAT provision, you have paid some additional amount. That is allowed as a tax credit to you. This credit, of course, no interest is paid to you on such credit. It is allowed to be carried forward and set off in any of the next 15 assessment years. What happens if you are not able to utilize in the next 15 years? It lapses, as simple as that. Now, after having carried forward this credit, how do you set it off? Is there any restriction on setting it off? Yes. Now, companies are expected to pay at least tax to the extent of MAT year on year. So that cannot be set off by utilizing tax credit or MAT credit. Therefore, in any year where MAT credit can be utilized, it has to be restricted to an extent which is the difference between the tax paid under normal provisions and the MAT. For example, if the tax that is actually paid in a given year, which is computed under the normal provision, is 100, and the tax that is payable under MAT provisions is 75. What can be set off is only to the extent of 25. The balance will get carried forward. So tax credit is restricted to the difference between the tax paid under normal provisions and the MAT payable, and the balance is allowed to be carried forward. An interesting problem may arise here. As you are aware, if a company in India pays tax on its income abroad under DTAA, it is allowed a tax credit of the tax paid in the foreign country. The tax credit is allowed because same income is taxable in India also. Now, how much of this tax credit is normally allowed? Only to the extent of tax payable under the Indian Income Tax Act on such income. For example, say there is an income, we will describe it as income A. On such income, in US, somebody has paid tax of 50. But in India, on such income, tax payable is only 30. Such person is allowed credit only to the extent of 30 out of the tax that he has paid in US. The balance 20 is not available. Incidentally, MAT can also be discharged by utilizing this foreign tax credit. Now, it may so happen that the person who has got foreign tax credit may utilize this foreign tax credit to discharge his full MAT liability. Now, you look at the problem that arises. If there was no MAT provisions, his foreign tax credit would have got restricted only to the tax payable under normal circumstances on his total income. But because of this MAT and the provisions which are available to him to carry forward the tax credit, it is possible that his foreign tax credit may get carried forward for future years. So therefore, to prevent such a carry forward, there is a restriction where it says if there is any such excess tax credit which is over and above what he would have otherwise got under normal circumstances, that will not be allowed to be carried forward. There are certain companies which are not liable for MAT. As you are aware, now we have two types of companies: manufacturing companies, which are eligible to pay tax only at the rate of 15%. And there are other domestic companies which, by making a choice, need to pay only 22% corporate tax. Such companies are not liable to pay MAT. MAT provisions are not applicable in such cases. Now, as far as this book profit is concerned, how does one go about? Because we have seen calculating book profit is a very complicated exercise, or at least it is not an easy exercise. How do you ensure that the book profit figure that is calculated is correct? Responsibility is given, as usual, to the auditors. Auditors have to issue Form 29B, which details the computation of book profit. Now, a question may arise whether officer can go into this report and make changes in such report. Supreme Court has held it very clearly. Auditors are experts. Once an expert, using his expertise, issues a certificate, officer cannot get into the process of verifying the correctness of such figure given by the chartered accountant. So therefore, to that extent, whatever the auditor certifies stands. That becomes the final thing. Another question may arise. Let us say companies actually having a loss which can be carried forward, or there might be unabsorbed depreciation, which in the normal circumstances would have been allowed to be carried forward. But because of these MAT provisions, company ends up paying MAT. And in a later year, it may so happen, it may pay tax under the normal provisions. Now, while calculating its total income under normal provisions, whether it can set off the loss that it has incurred in the earlier years, or whether the depreciation which is unabsorbed can be added to the depreciation of that year, and whether deduction can be claimed. The section itself makes it very clear. Initially, there was a Supreme Court decision which said, notwithstanding the fact that somebody has paid tax under the MAT provision, it doesn't mean that he forgoes his right to carry forward his unabsorbed depreciation or his business losses. He should be allowed. Now, there is a specific provision which says that even though somebody pays a MAT, if there is any unabsorbed depreciation under the other provisions of the Act, or there is carry forward claims of losses, it will be allowed to be carried forward. Only requirement is under Section 80, he has to file his return of income before the due date in order to be eligible to carry forward such. So there are certain cases where we have seen companies paying tax of 15%, that is 115 BAA, and 22%, that is under section 115 BAB. They are not liable to pay any MAT. I think with that, I have covered the MAT provisions. If there are any questions on this, I will take it right now, and thereafter probably we can move to alternate minimum tax. Any questions? Okay. So if there are no questions, let me move on to the alternate. Like MAT is in the case of corporates, AMT or alternate minimum tax is for SSEs other than corporates, basically individuals, firms, LLPs, etc. Yeah, before I come here, let me just go back for a second. What happens when there is reorganization of companies? For example, a private limited company or an unlisted public limited company converts itself into a LLP and it has got MAT credit. It's a different matter that LLP may not be able to utilize this MAT, but it may so happen after some time this LLP may once again decide to convert itself into a company. In such cases, whether this MAT credit will continue to be available? The answer is no, because there is a very specific provision. In the case of such reorganization, the MAT credit lapses. Similarly, when the company opts for paying taxes of 22% under that 115 BAB, if there is any MAT credit, that MAT credit will have to be foregone by such company. Now, little bit about accounting treatment for the MAT credit. Whether this MAT credit, because it arises in 1 year and it is set off in another year, whether some deferred tax adjustment as provided in accounting standard 22 will have to be made. There is a clarification issued by the institute which says accounting standard 22 dealing with taxes talks of timing difference of income, whereas MAT credit is a tax, it is not an income. Therefore, MAT credit doesn't give rise to any deferred tax assets. How does one account for this MAT credit? Should one at all account the MAT credit, show it as an asset in the balance sheet? Again, the same clarification goes a step further and says it all depends upon the evidences that is available with the company that there will be sufficient future taxable income or tax payable by the company against which this MAT credit can be utilized. Something like a virtual certainty that we have with respect to taxes on income, that is creation of a deferred tax asset. As you are aware, if there is a virtual certainty that the losses incurred in 1 year, you will be able to set it off against the profit, or there will be a virtual certainty that in a future year, there will be future profits. And against that, this tax asset can be utilized. Only in such circumstances, you recognize the deferred tax asset. Otherwise, you don't recognize it. Same rules apply even with respect to accounting for MAT credit. If there is some sort of virtual certainty that you will be able to utilize it on a future date, then it can be shown as an asset under loans and advances with a corresponding credit to the profit and loss account, saying that future MAT entitlement. Now, coming to alternate minimum tax, it is applicable to SSEs other than corporates. Here also, we have a concept of adjusted total income, which is akin to something like adjusted book profit. What is this adjusted total income? You have total income computed under the normal provisions of the Income Tax Act. You increase it by the deduction that you have claimed under Chapter 6A, that is whether it is ATC deductions or all such deductions, you ignore or add it back to the total income that you have arrived at. And what other additions will be there? Deduction under 10AA today, it is not relevant. Somebody has claimed 35 AD, that is deduction for investment in capital assets. If somebody makes any investment in capital asset, he is allowed to deduct the cost of the asset in computing his profits and gains of business. If any such deductions have been claimed, that also should be added back to the total income that is arrived in his case. The resultant figure would be the adjusted total income. Find out 18.5% of such adjusted total income, which is the alternate minimum tax. Find out the tax payable by him under normal provisions of the Act. If the tax payable under normal provisions of the Act is less than 18.5% of his adjusted total income, then he has to pay alternate minimum tax, which is 18.5% of his adjusted total income. As in the case of corporates, tax credit is allowed. Tax credit is allowed to the extent of difference between alternate minimum tax and the tax payable under normal provisions of the Income Tax Act. Again, it is allowed to be carried forward for 15 years and it can be set off against the tax payable under normal provisions of the Act, and set off is limited to the extent of difference between tax payable under normal provisions of the Act and alternate minimum tax. Entire amount cannot be claimed. Again, there are certain exceptions. One is if somebody's adjusted total income is less than 20 lakhs, then these provisions are not applicable. Similarly, if somebody has opted for that new scheme of payment of deductions, even in such cases, these alternate minimum tax provisions are not applicable. Wherever such SSEs are required to pay tax under this scheme, they have to get their adjusted total income certified in a form called 29C. With this, I think I have come to the end of my presentation. There is nothing more. If any questions are there, I'll be happy to take. Otherwise, we can wind up the program. Hello? Hello? Oh, there are some question and answer. Questions are there. Answers I have to give. Bharat EM, is interest on TDS, is income tax to be added back to MAT profit? This is interest payable on delayed remittance of TDS. Interest payable under Income Tax Act is treated as income tax by the interest any interest charged under this act is income tax. Therefore, it has to be added back to book profit. Can we reduce 50% each of unabsorbed depreciation and book loss in the year of set-off or any method prescribed for such a set-off? As far as my knowledge goes, there are no prescription under the rules. This is what I made it clear. There is some issue with regard to this. How does one go about quantifying the amount to be set off when you carry forward the depreciation and unabsorbed depreciation and brought forward losses?
I think that's all, sir.
That's all. So thank you very much for a fruitful evening. At least for me, it was fruitful. So thank you very much. Look forward to meeting you again.
Thank you, sir. That was an excellent session. This comes only with experience which you have. I thank you on behalf of the managing committee members of Bangalore branch and the members who have attended this session. I seek your support in the future also. I'd also thank the members who have attended this study circle event. Thank you, sir.
Thank you very much.
Thank you very much, sir. Thank you very much.
Thank you. Yeah, bye.
Thank you, sir.